Please welcome to the stage TCW CEO Katie Koch with Bloomberg's Romaine Bostick.
I'm glad everybody made it back in. I know Tom Keene's still out there taking selfies. Only $5 a pop, by the way, if you want one. Katie, great to have you here.
It's always awesome to be here.
It's always a whirlwind, of course, so working in this business, a whirlwind, of course, given economic conditions right now. And there is a lot of discussion here about volatility and what it means for a manager like yourself.
Yeah, so there is a lot, particularly in bond markets, that's quite pronounced. And I think the real reason for that is that we are at the precipice of the economic landscape changing and people really wondering whether we're going to have a recession and what type of landing we're going to have. And I think until we get more certainty around that, we should expect that to be the continued backdrop for investing.
Why don't you think we have a little bit more certainty around that? I mean, it's 5 percentage points of hikes. It's been more than a year and a half.
Yeah.
The data's there. If you're dependent on it, what are you seeing?
Yeah, well, I think there's 100% certainty we're going to have a recession because that's the way the world works. It's just the timing, right? When it happens is the harder thing to call. But at TCW, our view is that we are going to have a medium to hard landing, and I'll unpack that a little bit as to why we think that's the case. The first is that we really have had 15 years of uninterrupted expansion, just a little blip during COVID. And the longer the recovery, kind of the more excess we have to work out of the system. And something we look at a lot on our team is M2. And you know, if you looked at what it did during COVID, it went all the way up, right? If you just look at a chart of that. And then we all told ourselves the nice story that was going to be transitory, drive transitory inflation. And that obviously turned out not to be the case. And it's come down dramatically back to the bottom of the chart. And I think the nice story to tell ourselves is that we're going to get a soft landing, but we don't think that's the reality. We think it's going to be a little tougher than that. And part of it's because of the excess to work out, as mentioned. I think, the second thing I would just say is that we do have a global call on liquidity now, too. We've talked about the fact that we think rates are going to go up. But in addition to that, if you look at what's happening with the regional banks, which are a very important source of financing, they're much more constrained for the issues we all know because of deposit flight. And so if we look at our portfolio companies, they're really struggling to renew revolvers and extend loans, and that's going to have a real economic impact. And even if you...
But we're already hearing that. I mean, we've heard from several banks have already pulled back in certain areas of lending, including automotive, as well as obviously lower quality here. You expect that to increase? Yeah,
it needs to go. We need to have the recession that will have to show up in the job market. And we're starting to see early signs of that, but you obviously need that to get worse. The way that this works generally is that rates go up, financial conditions tighten, and then what happens is that consumption drops, investment drops, and then we get job destruction. That's the general arc of a recession. And
are we following that cycle now?
I think we are, and we think we are. Again, it's going to be it's going to be challenging and potentially that medium to hard landing. And that's what I would watch out is what are rates doing? This global call on liquidity is going to continue to be quite severe. And then, just the final comment I would make is that when capital reprices this aggressively, things do break. And we've seen some signs of that, and there's more things to dislocate ahead. But I just want to end by saying at TCW, we're value-oriented investors. And so, this can create tremendous opportunity, too, to identify those dislocations and to lean in on behalf of our clients.
Of course, trying to identify that in this environment comes with a certain degree of risk as well here. What actually constitutes value right now out there?
From an asset class perspective, and I'm glad you asked that because I wanted to talk a little bit about private credit.
Okay.
And this is a new...
You have friends in private credit?
I have friends in private credit. We have a great private credit team, but also it gives me a chance to give a new headline because when I was at Milken, your colleague Shonali interviewed me about private credit, and the headline that Bloomberg picked up was "Big Accidents Ahead."
Yeah,
it was It was amusing because my head of distribution was there, and we had just done 40 LP meetings, and he was like, we're here trying to raise capital, right? Yeah. But if you had listened to what I was saying after that, so this is my new chance, my second chance for my Bloomberg headline. So I'm going to say private credit.
I hope everyone's ready.
Yep, get your pens out. Private credit epic opportunity, manager selection matters,
We're
okay?
going to definitely make that one happen. And be careful.
Yeah.
Be careful with Shonali. You know, she can be a little tough in the interviews there.
So she's fantastic, and it was very fun to talk to her. But I did get that message out. I do want to unpack that. It's going to be an epic opportunity because whenever capital, withdraws, like therefore there's an opportunity for outsized returns, and we think that's what the next decade's going to look like.
Right.
The manager selection matters point is two quick things to say on that. That 96% of private credit managers started post-global financial crisis in a low to zero rate environment. And we all get to be geniuses in that environment when capital's free. And in addition, if you look at the covenant-light loans that exist now, they're at a 3 times higher volume than they were pre-GFC. And we are starting to see some cracks in the private credit market. We have a second quarter of where defaults have actually gone up. And so that's the backdrop from which private credit matters.
Right.
And just to end with kind of our approach, and I think it'll be interesting to people watching this because it helps give you a sense of what to ask your managers.
Sure.
Our private credit team is led by Rick Miller. He's an incredible investor and leader, and one of the few people in the team that's been doing this for 20 years. So we've actually invested through 3 recessions, made about 300 investments, and only lost money in a handful of them. So I think there's a lot of wisdom to share from that team. And they would say covenants matter, diligence matters, origination in this asset class matters very, very deeply, and the ability to have restructuring experience. And so I would really spend a lot of time, if a lot of people are looking to put capital to work in private credit, I think pushing into those issues, what are the covenants you put in place? Because when things go sideways, covenants give you a seat at the table. Have you diligenced this asset very heavily, and in what ways? Really push your manager on that. Origination, if you've been reliant on big private equity sponsors for origination, that's just going to become much harder deal flow in the coming years because we know fundraising's down in private equity origination. And then in restructuring experience, pushing them, like, have you been at a credit committee at 2 a.m. eating cold pizza and fighting over the asset before? And if you've gotten it back, have you figured out a way to fix it? I mean, these are important things to ask.
I'm curious as to what a restructuring cycle actually looks like. I mean, you mentioned sort of, more than a decade of uninterrupted growth in financial markets, obviously aided by lower rates. That, of course, means that coming out of that, whatever this new normal is going to be, can you bank on that restructuring cycle to look similar to what we saw prior to the global financial crisis?
I think generally these things work the same way. And there is, again, opportunity. We just talked about one in private credit. I think there'll be parts of the real estate market that could be opportunities as well. And it will look similar, working the excess out of the system, owning the right assets, repositioning those assets and to perform when the economy does recover. It is very clear. I mean, the one thing that I certainly learned in investing through 3 recessions is that the best opportunities are coming on the other side of them. And that's a great opportunity for asset owners around the world if they're positioned correctly.
You mentioned real estate. Let's talk a little bit about that because there are a lot of mixed views about whether there is opportunity in that space. There's something to be found, but there are a lot of people think that there are structural changes coming, particularly in the commercial real estate side. That will probably a lot different than what any of us have seen in our lifetime.
Yeah, I think maybe to state the obvious, but it's a good place to start. There are always opportunities in real estate. It's the world's largest asset class. I think sector selection has mattered and continues to matter an enormous amount for that asset class. And I'll start with the securitized part of it. At TCW, we run $95 billion on behalf of clients in securitized assets. And I was having this conversation with Liza Crawford, who's a leader in that space, and Brian Whalen, he's our co-CIO and has been investing in that space for a few decades. The way that we're positioned there for clients is that we are positive on residential for the obvious reasons. It continues to be an undersupplied market. And for those of you who are fortunate to be homeowners in this room that have a 30-year fixed mortgage, you're probably not thinking about moving soon because you are obviously in a good position relative to where rates are. So we expect people to stay in their homes. And on the commercial side, there are going to be some real challenges ahead. So if you look at the CMBS market broadly, $3 trillion of that, 50% of it is up to be, extended basically at 4 points higher. So that's going to cause some real issues. And then just to dig into that for a second, the area we're obviously most concerned about, I don't think it makes us unique, but is office. And I think it's really important to think about these things in historical parallels. And I think what happened with retail provides an interesting lens for thinking about what's happening in office across the cap structure. So in retail, we had the internet, we had Amazon, it disrupted the market. Brick and mortar shrunk dramatically, obviously, in terms of square footage. But there was still some winners in that space, right? Class A malls, like the one I live across from in Tribeca with Brookfield. These are actually trophy properties still. So there are, through selection, you can find good assets. And then on the other side of the spectrum, we have deadmalls.com, right? And like those malls are now trampoline parks or data centers.
Yeah, so I wake up every morning with that website. I am curious. You mentioned Brookfield and the mall there, but we talk about the support for that mall often comes from those offices up top.
Yeah.
You know the vacancy rates that we've seen, at least publicly, that have been reported here.
Yeah.
I mean, what gets that back? There's still this broad discussion here about hybrid work from home. I mean, we were just talking backstage, our colleagues and I, and Martha Stewart was railing against everybody working from home, which I thought was rich, given that, she spent most of her life filming her show from home.
Yeah.
But it gets to the broader issue that we still haven't sorted this out, and no one really seems to know where we're going.
Yeah, so, I mean, just to extend that in office, I think square footage is going to have to get taken out because we have collectively as a country moved towards a more hybrid working model. It's not going to go to zero, but it's going to need to adjust just like retail did. And I think there'll be some great opportunities because in the offices, the equivalent of the best malls and the best offices, we need to give people a reason to come into work. Like, you guys have the 6th floor here, and that's why I come to Bloomberg early is to get the free coffee.
Yeah, I saw you scrounging out.
Yeah, just look at my purse. No, but like
check her on the way out.
you do. I mean, that you have a reason for people to come in here: the daylight, the activity, the free food. And we need to provide those amenities in offices. So there are going to be opportunities for great properties, and there's going to be a lot of square footage that goes away, and that could be converted in some instances. It's not economically feasible, not to go into all the details, but in some instances, in some markets, it can be converted to multifamily. Maybe where if it's near a cheap source of energy, it could be converted into data, and some of those properties will be reinvented.
So you're smart enough to understand those potential opportunities. For investors that are approaching you or approaching other managers of the company, are they also looking into that space? Do they have that same sense of understanding?
Yeah, I mean, I think in real estate, there's going to be tremendous opportunities. Selectivity matters. I think it matters both in the public equity markets and the private equity markets, and same thing on the credit side. And yes, I think that we're all trying to attack that thoughtfully for our clients.
There are broader issues here about when we get to whatever the end of this rate tightening cycle is, if we do go into a recession, what's on the back end of that recession? Is it going to be growth at a level that maybe we were used to prior? There's been a lot of talk about stagflation. Even earlier today, John Waldron was talking about this idea of mini stagflation. I'm not quite sure the context, but we've heard this from a lot of folks before.
Yeah, I'm just a believer that growth will recover. I believe that we will continue to innovate and find new paths for growth. I think that's just been the long arc of history. So I think we'll get a recession and we'll recover, at least in this country, to normalize growth levels. And we don't have to talk about AI because people are probably bored of that and everyone's talked about it. But generative AI is just another example of how we continue to innovate and push forward and create opportunities for margin expansion and additional global growth opportunities. So I'm pretty optimistic that we'll recover to new levels.
And you've seen a lot of investors, I mean, not to go too deep into AI, but overall, there seems to be this appetite or this want for something that's bigger, something that's structural in the markets that obviously will have a payoff down the road. Is there something else out there that you have your eye on? Yeah,
I mean, for sure. I want to talk a little bit about public and private markets and how that's going to evolve. So remind me to come back to that. But just to stick on technology, I mean, as someone who's invested for a long time in public equity markets love a narrative. And one of the reasons that we're up 10, 12, whatever % this year is because we have a good narrative with AI. And as you know, almost all of that return's coming from 7 companies that in some way are linked to that narrative. And so I do think it's real. I think there are companies that are solutions providers to that have obviously done very well. And I think it's going to provide, including for the business that I run, I think it's going to provide massive opportunities for margin expansion. So I think that's good. We'll be over optimistic about it and we'll be too euphoric, and then it will come back to a more reasonable place. But I believe it's a transformative technology that's going to have great investment opportunities in public and private markets and have tremendous margin potential for certain companies, and that it will also create great disruption. Just last comment on equity markets. The challenge is I think we had a resilient first quarter of earnings. I think the second quarter is going to be more challenged with rates going up and actually, at least at this very moment in time, pressure on margins. And I think that could be a headwind to equity markets. And finally, the multiple is still very expensive relative to history, despite us facing challenges. So
when you talk about the multiple, you're saying the overall market.
Yeah, the price to earnings multiple still elevated over history, and that doesn't really fit with the current economic environment.
Well, obviously, in your current job, you have a huge bond portfolio. Your previous job, you were steeped in equities here. Are those two worlds speaking the same language right now?
Yeah, I think equity markets are showing more optimism at the moment than the bond markets.
As they always do. And bond markets are showing pessimism?
Yeah. I'm working on that because I'm a generally optimistic person, so I'm learning to be more balanced. It's something I'm working at now that I'm at a more fixed income heavy shop. But we do have a very strong public equity business as well, and that's where those ideas come from. I will say, I do think where you are seeing differences in the way things are being priced is between the public and private markets. And so I think that's something that is really important for asset owners to think about how they're going to be allocated across the private and public markets, both equity and debt in their portfolios.
It gets to the question, too, about whether those two worlds could live together, assuming that they are looking at economic conditions in the world kind of at least slightly different ways here. So even if you have valuations stretched on an aggregate basis in the market, some would say, well, on an individual basis, there are a lot of stocks that are still, in theory, at value levels, right?
Yeah.
Then you look at the same thing. You have some of the same bifurcation in the fixed income market as well.
Yeah, that's right. And I mean, I think we were just talking about office before, so to use that again, that gets taking public and private markets, just big picture statement to respond to your question. People need to have exposure to both, because what you're trying to do in your portfolio is just kind of reflect the productive capacity of the world, and now it really exists in size in both markets. And so I'd start with that. And then I would say the other reason to be thinking about both of them is that there's arbitrage opportunities. And the reality is that when news comes in, it just gets imputed much more quickly into public markets. And office is a great example of how quickly that got priced into REITs, publicly listed REITs versus other markets. And so there's a way to arbitrage that. And then the final point I would make relative to fixed income, I mean, I lived through this as a public equity investor. The private markets just took so much more share of equity markets, and we now have 50% less public listed companies in the United States than we had 20 years ago.
Right.
And through that pattern recognition, I think that story is coming to fixed income markets, and that we're going to have, I believe that we'll continue to have a disruption of liquid fixed income markets. We've already seen that. That's why.
What's the catalyst for that? Because I mean, the whole growth of the private business really, to a certain extent, was born out of the global financial crisis and zero bound rates, and that really sort of accelerated.
Yeah, that's right.
And I don't know what everybody's doing out in California, but obviously all those firms are kind of at the forefront of it. But I mean, what's the next catalyst that takes them from where they are now and doubles that market value?
Well, in private equity, low rates certainly helped, but also there's value add. There's some incredible private equity companies that can really value add on top of their in the running of those companies, which provides excess return to clients, which is great. And I think also there's a lot of companies that, because there was more capital available, might argue it's more fun to be a CEO of a private company than a public company because of the regulatory scrutiny around that. So that kind of is in the equity direction. On the debt side, obviously, because of regulation, banks have had to withdraw from the way that they finance things, and so they've gone from a syndicated market to a more private market, and that is the story behind why direct lending specifically has become such a big market. But there is going to be further privatization, for example, in the securitized market, where you're going to see more private and less liquid securitized plays. And so broadly, while we continue to be very positive, particularly on idiosyncratic opportunities in the liquid fixed income market, we are preparing ourselves for a world where there's going to be more fixed income opportunities in the private market.
The retrenchment that we're seeing by banks, the traditional banks, you expect that to continue accelerate?
Yeah, and there's just real regulatory issues that we are getting disintermediation of lending. And I will just one thing to highlight too is speaking to our credit team. Steve Purdy, Jerry Kudzel, Brian Gelfand, who is a leader in our high yield space specifically. The fact that banks have withdrawn from that space, but in addition, actually hedge funds, so smart money in the credit space, have started to do more private than public.
Right.
Then the banks are covering those companies less,
Yeah.
which means that liquidity has thinned, research coverage has gone down, and actually it's creating idiosyncratic opportunities in that liquid part of the market, which I think is interesting and something that people should focus on as an alpha source.
One final question, though,
Yeah.
on that point, though. As that private world grows and grows, there's been a lot of talk as to whether there should be more regulation vis-a-vis, what we see with traditional banks. Is that not at all a worry that maybe one day the folks in Washington wake up and say, maybe we should do more?
I think it is always good to have regulation on the way that we invest, both for institutional and individual investors. And so regulation has perhaps had the unintended consequence of moving more into the private market. And I think it's reasonable to expect that there will be elevated levels of regulation for that. And as long as that's in the best interest for our asset owners, I think that's a good thing.
All right, Katie, great conversation.
Thank you for having me.
Katie Koch, everyone, over at TCW. Thank you.